Basic concepts of auditing. This module includes scope, objective, significance of auditing, auditing standards, audit engagement, audit program, audit documentation, audit evidence, audit notebook, audit risk, assessment of audit risk, internal control, audit sampling, techniques and procedures, application of technology in audit and audit trail. Considering the possibility of unintentional mistake as well as organized frauds, an independent appraisal of the recorded fact is essential. Evolution of auditing. In 1866, the England's Exchequer and Audit Department was created by Act of Parliament. In 1870, the Institute of Accounts in the form of a society was formed in England. It got a royal charter in 1880 and was turned into an Institute of Chartered Accounts in England and Wales. In 1965, amendment in the Act took place and concept of cost audit was introduced. Also, in addition, there is an audit by Office of Controller and Audit General of India under CAG DPC Act. Definition. Audit has been derived from Latin word audere, which means to hear. In early days, person appointed to check the audit used to hear the accounts. So, from responsible officers. That's why he was called auditor. Some of the definitions given by few well-known experts in the field are above. Will are explained. Investigation of some statement of figures involving examination of certain evidence. Examination of balance sheet and profit and loss account prepared by others together with the books of accounts and vouchers relating thereto. Systematic examination of books and records. Auditing as inspecting, comparing, checking, reviewing, vouching, ascertaining, scrutinizing, examining, and verifying of books of accounts. Will will enable the auditor to satisfy himself that balance sheet is properly drawn up so as to give a true and fair view of the state of affairs of the business, and whether profit and loss account gives a true and fair of the financial period according to best information and explanation given to him. Thus, in its narrow sense, scope of an audit is limited to only authenticating the accounting records and thereby to assure the accuracy and reliability of financial statements and reports. Appraisal is an examination of value, condition, quality, etc. or something. As per general guidelines in internal auditing issued by Institute of Chartered Accounts of India, auditing is a systematic and independent examination of data, statement, records, operation and performance, financial or otherwise, of an enterprise for a stated purpose. In any auditing situation, the auditor receives and recognizes the proposition before him for examination, collects evidence, evaluates the same, and on this basis formulates his judgment, which is communicated through his audit report. According to them, auditing is the accumulation and evaluation of evidence about information to determine and report on the degree of correspondence between the information and established criteria. Thus, in broader perspective, auditing is a holistic appraisal of all relevant aspects, be it financial or otherwise, of an inquiry sought after a stated purpose. The term holistic refers to approach that considers the whole of something rather than just its parts. Essential features of auditing. It involves evaluation and verification of relevance, reliability, and adequacy of evidence in support of verifiable information such as vouchers, document explanation. It is analytical, critical, and investigative review of system of accounting and internal controls. The information audited may be financial or non-financial. There should be standards or criteria for evaluation of the information in a systematic and scientific manner. Auditors should be competent and independent, qualified, and possessing prescribed qualification and certificate of practice. It ensures reliability of information and authenticity of assertion made in the financial statement relating to enterprises, whether profit-oriented or not, and whether it is required by law or not, to enable the auditor to form his opinion on the statements with regard to true and fair view of state of affairs of business and profit and loss made during the period disclosed therein. Nature of auditing. An auditor examines internal evidence, that is, the records, vouchers, and books of accounts. To assess the quality of internal evidence, he also tests and evaluates the relevant system in the organization. He also obtains external evidence such as confirmation of bank balances. In some cases, he may decide to conduct physical counts and surveys or even call for independent expert opinion regarding technical matters. Auditing today may also involve review of compliance with the law, posting records, operations, and performance. Auditing should be done by a competent independent person. There should be standards or criteria for evaluation of the information. Should also have independent should also have an independent mental attitude. Okay, differences between accounting and auditing. Accounting is the collection, classification, and summarization of data for preparation of books of account to make financial statements. Auditing is an analytical and critical examination of those financial statements. Accounting is recording of transaction. Auditing is post-mortem examination of recorded transaction. Auditing reviews financial records to form an opinion on the authenticity of financial statement. Accounting, the primary responsibility of management towards shareholders on to maintain the financial records. Auditor is an independent person appointed by business entity to review the financial statement to give his opinion thereon. An accountant is not expected to review or report on financial statement, but to report the compilation of records to the manager. Auditor is required to submit a report with his opinion to true and fair assertion made in the financial statement to the owners. Accountant works for the management. Auditor is an independent person accountable to the owners or shareholder and not to the manager. In certain circumstances, auditor could be held liable to third parties also. Uh, Accounting is done as per principles set by Indian accounting standard. Auditing is done as per principles set in standards on auditing. Is a difference between auditing and investigation. Auditing is an independent and systematic examination of evidence underlying the accounting or other data in accordance with the generally accepted accounting principle to ascertain the true and fair view of the financial statement of an enterprise. Investigation will be defined as examination of accounts and records with a view to ascertain any fact or some special purpose, which varies from assignment to assignment. Audit has wide scope. In statutory audit, scope is determined by relevant law, and in case of private audit, management that is example management audit by a client. Scope of investigation is limited as regard the period or areas to be covered. Objective of audit is are very in audit accounts or records are verified as to their truth and fairness. Investigation is for special purpose. Example: investigation on behalf of incoming partner. Audit is conducted according to generally accepted accounting principle. Investigation involves an extended auditing procedure. Auditor will evaluate the accounting records predominantly based on persuasive evidence. Investigator can draw his conclusion only on the basis of substantial or sometimes conclusive evidence. Auditor is skeptical and not suspicious. Skeptical means an adjective that expresses doubt about something being true or useful. Whereas investigator starts with suspicion and collect evidence to either confirm or dispel that suspicion. Suspicion means a feeling or belief that someone has committed a crime or done something wrong. Auditing is a routine exercise, normally conducted annually. Investigation may be spread over a longer period than 1 year. Scope of auditing. According to SA 200, overall objectives of independent auditor and conduct of an audit in accordance with the auditing standards with the standards in auditing, the scope of audit should cover the following aspects. The auditor shall assess the reliability and sufficiency of the information contained in the underlying accounting records and shall undertake appropriate audit procedures for this purpose. Appropriate audit procedure may be include either compliance procedure, that is study of accounting system and internal control, or substantive procedure, that is testing the authenticity, accuracy, and completeness of information in the accounting records. The auditor has to determine whether the relevant information is properly disclosed in the financial statement in conformity with the applicable generally accepted accounting principle and statutory requirement, that is requirement as per accounting standards companies act. Auditor's work shall involve an exercise of judgment. He shall be principally concerned with items that either individually or as group or material in relation to the affairs of an organization. Basic principle governing an audit. As per SA 200, responsibility auditor's responsibility whenever an audit is carried out. Integrity, objectivity, and independence. Sincere and free from any influence on his work. Confidential. The auditor should not disclose the client's information to anybody without client's permission or under any regulatory requirement. Auditors should carefully supervise work performed by others, remains responsible for the work delegated by him to his assistant, other auditors or experts. Working paper which is maintained to demonstrate that the audit is in adherence to the basic principles. Should obtain knowledge about client's business to determine the nature, timing, and extent of audit procedures. Should obtain sufficient appropriate audit evidence through performing the compliance and substantive procedures. Understanding of the accounting system and related internal control helps in determining the nature, timing, and extent of the other audit procedures. On the basis of conclusions, auditor should give unqualified report or qualified report or adverse report or disclaimer report. Objectives of auditing: to obtain reasonable assurance about whether financial statement as a whole free from material mistakes, whether due to fraud or error, thereby enabling the auditor to express an opinion on whether the financial statements are prepared in all material aspects in accordance with the applicable financial reporting framework, and to report on the financial statements and communicate as required by the standard on auditing in accordance with the auditor's findings. Primary objectives of auditing: true and fair view. Section 143 of Companies Act 2030 requires the auditor of company to state if, in his opinion, the financial statement present true and fair view of the state of a company's affairs at the end of its financial year and the profit and loss for the financial year. Such an opinion by the auditor increases the reliability of company's financial statements. Secondary objective is detecting frauds or error. If the auditor suspects the presence of material misstatement or deflection in the recording of records of the business, he is expected to look into matter with greater detail by applying various audit procedures to satisfy himself about their existence or non-existence. He is also to report on the existence of such a misstatement and their magnitude through his audit report. Social objectives: to protect shareholders' interests, to stop evasion of tax, to safeguard against capital erosion, to ensure fair return on investor, to ensure reasonable price to customer, to ensure fair compensation to workers, complying with the policy regarding corporate social responsibility. Significance of auditing: all company accounts have to conform to the requirement of Companies Act 2013. In addition, all accounts should conform to the requirement of accounting standard or Indian accounting standard. It is essential that audit should be carried out on financial statement to ensure that they conform to these requirements. From legal point of view, filing of income tax return auditing is significant. Profit and loss prepared by qualified auditor. Tax authority generally accept the profit and loss account prepared by qualified auditor. Borrowing of money from external sources. Most of the financial institutions sanctions various loans on the basis of audited financial statement. Statement of insurance claim. In case of flood, fire, etc., insurance company may settle the claim for loss or damages on the basis of audited accounts of the previous year. Sales tax payment. Audited book of account may generally be accepted by sales tax authorities. Audited accounts serve as a basis to determine action in bankruptcy and insolvency cases. From internal control point of view, quick discovery of errors and frauds. Errors and frauds are located at early stage. Moral check on employees. The auditing of the account keep the account clerks and the accountants regular and vigilant. Advice to management. Management may consult the auditor, although it is not the duty of auditor to give advice. Uniformity in accounts. Accounts of one year can be compared with other years, and if there is any discrepancy, the cost may be incurred into. From external point of view, settlement of accounts. Audited accounts would facilitate the settlement of accounts of a deceased partner. Valuation of assets and goodwill. There may not be much difficulty regarding the valuation of assets and goodwill as the accounts have already been audited by an independent person. Future trend of the business. From the audited books of account, the future trend of business can be easily assessed with certainty. Advantages of audit. Audit is a tool stakeholders can use to protect their interest. Audit is not only corrective measure but has a deterrent effect. Deterrence refers to the crime prevention effect of a threat of punishment. It serves as a moral check on the employees from committing defalcations or embezzlements. Defalcation refers to the misuse of fund by a trustee or a flawed accounting practice. Embezzlement means the crime of secretly taking money that is in your care that belongs to an organization or business you work for. By conducting audit, uh, it serves as a moral check on the employees from committing defalcations or embezzlements. Audited accounts are considered more reliable by different categories of government. Auditing helps in instituting corrective actions. Audited accounts are taken to be more reliable and useful during corporate restructuring exercises, valuation, etc. Bank, financial institution, and government require audited accounts before granting any financial assistance to the enterprise. Audited accounts are taken to be more helpful in settlement of accounts between partners, thus avoiding any dispute among them. Inherent limitations of an audit. Audit does not guarantee that all material misstatement will be detected because of the inherent limitation. Test the nature of audit. The audit evidence available to the auditor is persuasive rather than conclusive. Inherent limitation of internal control. Certain level of management may be in a position to override the controls. Professional skepticism. Professional skepticism means approach that would ensure that if something is wrong is detected, it is detected. The behavior of auditor helps in identifying and evaluating matters that increase the risk of material mistakes resulting fraud and error. Okay. Materiality is one of the basic fundamental concepts in process of auditing as well as accounting. Auditor has to constantly and continuously judge whether transaction is material or not. Materiality means important cost-wise, profit-wise, effective-wise, value-wise, which influences economic decision of user. Classification of auditing. Auditing are classified on the basis of organizational structure-wise classification, objective-wise classification, periodicity-wise classification, scope-wise classification, and subject matter-wise classification. Organizational structure-wise classification. First, statutory audit. Statutory audit means checking of accounts as required by law. The manner of reporting, contents of the report, and the authority to which the report of auditor should be presented are all specified by the statute. Companies, in case of companies, Companies Act 2018 governs the audit. In case of government body, the audit is set by Comptroller and Audit General of India and the Companies Act 2030. In case of insurance company or a nationalized bank, audit is governed by specific statutes and IRDAI or RBI guidelines. In the case of cooperative banks, the audit are governed by Cooperative Societies Act 1912. Statutory auditor of a company is appointed by the board or shareholders in the general meeting, and shareholders cannot delegate this power to directors even by passing a special resolution. Statutory audit can be appointed by the central government if shareholders fail to appoint an auditor. Statutory audit should be performed by a qualified chartered accountant holding a valid certificate of practice and not by any other person. Advantages of statutory audit. Okay. Independent opinion by the auditor increases the reliability, authenticity, and credibility of financial statements, which may be required by different users. Users of audited financials are shareholders for their economic decision, for timely tax assessments, for determining purchase or sale consideration on concern, settlement of partners' accounts, or audit financially used before court for settlement of disputes, for determining actual value of business, getting financial assistance. Then audited financials are used for getting government grants and availing tax exemptions, evaluation of internal control system, and strengthening it by removing the inherent weakness and checking the efficacy of internal check. Efficacy is the ability to perform a task to a satisfactory or respected degree. For checking the integrity of management. For other users, audited financials are used to ensure that any assumption in the finance statement are neither overstated or understated nor misrepresented. For the proper distribution of profits, ensuring proper distribution of profits as dividend. Audited financials ensuring that all legal requirements are fulfilled and statutory compliance are adhered. For settlements of insurance claims. Non-statutory audit or private audit is kind of audit is arranged purely voluntarily or sometimes as per internal rules of organization. It is as per an agreement which determines the nature and scope of audit to be conducted, the rights and duties of the auditor, requirement of reporting, etc. Some of the benefit of non-statutory or private audit are: for sole proprietor, it evaluates the internal control system and strengthens it by removing weakness. It increases the reliability and authenticity of financial statement. It helps in timely finalization of financial annual financial statement tax assessment. It keeps a moral check on the working of employees. It helps them in obtaining funds easily from a financial institution, help in trading dispute, travel dispute, insurance claims. Advantages of auditing for partnership firms. It helps in settlement of accounts among partners, protect the interest of minors, sleeping partners, partners who are not involved in day-to-day operation, and keeps a check on the person who are working on behalf of others. It enables firms to get loans from banks, finances as they rely on audited financial. Difference between statutory and non-statutory. Statutory audit is compulsory, whereas non-statutory audit is voluntary. Statutory audit is as per statute or law. Here, non-statutory audit, employer or partner determines the scope of work. In statutory audit, qualification is prescribed. In non-statutory audit, audit need not possess any academic professional qualification. Power, right, and duties of auditor are dictated by statute. In non-statutory audit, the agreement between auditor and firm decides this matter. Auditor has independence in status and in mental status. Here, audit does not enjoy such independence. Auditor's liability. In statutory audit, auditor is liable for negligence under common law and for misfeasance under relevant statute governing the audit. Misfeasance is the act of engaging in an action or duty but failing to perform the duty correctly. It refers to action that is unintentional. But in non-statutory audit, auditor is liable for negligence only under common law. Publication of audit reports. In statutory audit, audit reports is published for the public. In non-statutory audit report is made known to employees or partners only. Objective-wise classification of audit. First, internal audit. It not only includes matters related to finance but also critical appraisal of policies and procedures of the company. Internal audit is based on principle of early detection and prevention of further damage. Independent financial audit. Independent financial audit may be conducted by a qualified auditor at a request of a client, which may be sole proprietor, partnership, non-profit, or any other entity. Its objective is to comment on the truthfulness and fairness of the financial statement, and it may be compulsory under some act which governs the entity. Periodicity-wise classification of audit. Final audit is conducted at the end of accounting year. Auditor may use statistical sampling methods. The possibility of tampering with the book of account during the audit is considerably reduced as the audit work starts only after the books are closed. Tampering refers to action of touching or making changes to something that you should not, often in a way that is unauthorized or improper. Advantage limitation. Okay. Final audit is cost effective. It ensures continuous focus planned approach. Disadvantage: all errors or frauds are found at the end of the accounting year, which make it difficult to fix responsibility for defalcation. Sample testing, which also reduce the possibility of detection of fraud. Interim audit. It conducted between two annual audits, quarterly or half year, with an interim objective of declaration of interim dividend or valuation of share or certain date in case of mergers. It is useful for ascertainment of interim profit. For in case of declaration of interim dividend, change in structure of partnership firm, determining goodwill and net worth for acquisition purpose, investigation of a suspected fraud, obtaining loan from financial institution, interim audit is benefit. Useful. Continuous audit. According to the Institute of Internal Auditors USA, a method used to perform control and risk assessment automatically on more frequent basis. Ongoing audit testing of 100% of transaction. Continuous auditing changes the audit paradigm from periodic review of a sample transaction to ongoing testing of 100% of transaction. Paradigm is a model or pattern for something that may be copied. It become integral part of modern auditing at many levels. Technology is the key to enable such approach. It is throughout the year. Benefit of continuous audit. It is conducted throughout the year. It's testing 100% of transaction. Technology is important. It provides advanced notice about errors and irregularities detected. Surprise visit by auditor involved. Necessary of continuous audit. Where internal controls are inadequate, continuous audit is necessary. Transaction run in large numbers, continuous audit is necessary. When management is interested in getting statement of accounts audited periodically for enabling better management of resources. Advantages of continuous audit. Early location of errors and fraud, quick rectification, continuous guidance to client, make employees more efficient in conducting their work. Statutory auditors focus, allows them to focus efforts on more valuable activities. But what are the demerits of continuous audit? It may be altered after the audit is over. Frequent visit made by auditor may cause inconvenience at work. Clash of duties between his staff and that of auditors. Clash of work. More expensive because auditor has to devote more time to his audit. Work of audit becomes too mechanical and repetitive work. Difference between continuous audit and periodic audit. Continuous audit is throughout the year. Periodic audit after preparation of final accounts. Continuous audit is more expensive. Periodically is expensive. In continuous audit, errors and fraud are detected early date. In periodic are detected in the later date. In continuous audit, detailed checking is possible. In periodical audit, detailed checking is not possible. In the it helps in finalization of accounts. It does not facilitate declaration of interim. Okay. The monotony of the audit staff. Monotony means lack of variety and interest, tedious repetition or routine. Continuous audit leads to monotony of the audit staff as they are engaged in the same work throughout the year. Periodic audit does not lead to monotony as the staff are engaged in different organizations. Continuous audit improve the efficiency of clients' accounting staff. Periodic audit may become the here accounting staff may become lazy and inefficient and keeps work pending. There is a possibility of collusion between audit staff and employees of the organization. There is hardly any possibility of collusion in periodic audit. And audit staff are continuously engaged in the organization. It maintains a moral pressure on the client staff. There will be less moral pressure in periodical audit. Continuous audit is applicable for large organization. Periodical audit is for small organization. Continuous audit facilitates timely submission of audit report. Periodical audit takes time to prepare and submit. Limited review. What is limited review? As per clause 33 of SEBI listing obligation and disclosure requirement regulation 2015, as per SEBI LODR 2015, company shall submit its quarterly, year-to-date, and annual financial results to the stock exchange in the manner prescribed in this clause. Accordingly, a company has an option to submit auditor on unaudited quarterly and year-to-date financial results as to stock exchange within 45 days from the end of each quarter. So instead of conducting a full-fledged audit, the auditor has to make a restricted study of books of account and other documents. This system of review is called limited review. It is to be noted that in case of limited review, generally accepted accounting standards are not followed. So the scope of limited review is substantially narrower as compared to audit.